All right. All right. Welcome again to, our sixth installment of the mortgage education series. It might be our seventh. One of the things that we love to do is educate. So, talking about everything from VA loans to credit and uh, just everything. It's been really fun. And so, we've been doing this now since we did a little bit in November, and every Wednesday at 10 a.m. All these are on recording on YouTube, so you can check them out. And it's been fun. It's actually, the people that we've met, and, just kind of diving into some of the basics that is missed a lot. So today we're going to talk about regular mortgage loans with less than perfect credit. Now, when I got into the industry in 2015, this type of loan transaction is really what we did, that I remember doing a lot of from 2016 to 2019. A lot of imperfect credit. And that the cool thing about that is I have seen people go from, 580 credit buying their first home. And then all of a sudden, a couple years later, they're utilizing the equity in that house. They now have 800 credit. They're able to pay off all their debt. It's really cool. So that's what we're going to talk about today, is just, the perception is that you need to have all the stars aligned, but you really don't. If you can just do a few little things, it can really get you in that doorway to then have those, future transactions that are just setting you up for more success. All right. Simply put, what is a mortgage? Well, it is a loan for buying a property. So some people ironically don't even understand that concept. And then the property that you purchase is it actually, the land is the collateral for that loan. But how do credit score and mortgages connect, right? So credit score will affect the terms of the mortgage. Now, when we dive into this a little bit, it can be challenging for some people, and they think, again, like I said earlier, you need to have perfect credit. That is not true. You can obtain a mortgage and not have perfect credit. So we're going to dive into the main loans that we see on a daily basis that will help you with less than perfect credit. We're going to talk about FHA, VA, USDA loans, and then also conventional loans. So with FHA is a great program that allows you to use low credit or even no credit. So you can literally have no credit or a 500 credit score and be able to get an FHA loan. We can do these with low down. So FHA typically is at 3.5%, but if you have a little bigger down, sometimes that helps when you have a lower credit score. When we get into the 500s, that is one of the things that we talk about in the office. If you're 500, you might be ignoring your bills a little bit. If you're 500 or below, you might just literally be ignoring your mail. But if you open your mail and try to pay attention to it, that 500 credit score can get you a mortgage. Now, what usually helps on FHA loans when you're in that sub 580 credit score is getting at least 10% down. Even 15% down allows for people who may not have that perfect credit to be able to get a loan. So sometimes you might hear your clients will say, I need that 20% down. You don't even need that when you have a 580 and below credit score with FHA. Different compensating factors go into that with FHA. We're going to look at the debt to income score. Now, when you have a lower credit score, we may not go as high on debt to income, but when we're looking at the debt to income score with FHA, typically we can go higher in debt to income. So we look at those factors, we look at the credit score, and with your bigger down payment, we might then be able to go and maximize that debt to income ratio. And then just for your own knowledge, with FHA, when you have fairly okay scores, I'm saying 620 and above, you can typically go up to, I've seen 56% on the total debt ratio for your income, your debt to income. So it's a pretty cool loan program. And then again, once you get into those lower credit scores, we may have to bring that debt to income ratio down, but it may be able again to go back up with that higher down payment. Now we're going to talk a little bit about VA loans. VA loans are one of my favorites to help with lower credit score, because the VA loan, for one, it is a loan program that helps veterans that have served our country, or people that have served our country. And you can do zero down, and there's no mortgage insurance. So really, it is a great program for anyone that qualifies for it. And you usually have favorable terms, and the credit score requirement is actually quite low. So we can do, again, it's similar with FHA in a sense that sometimes, with a 540 credit score, 580 credit score, having just a little down payment, even I've seen veterans with a lower 500 score with just 5% down, just a little skin in the game allows us to be able to do that loan. And then again, the biggest thing is with the VA is just making sure that the residual income, which we'll touch a little bit on residual income. So when we're looking at a VA loan, we can maximize our debt to income ratios, actually very similar to FHA and even higher. The VA does allow very high debt to income ratios. But then what they're also looking at is the leftover funds. So if you have a family of 4 and you live in the Northwest, you're going to need a little more income left over. So even if your debt to income is at 50, the VA wants to make sure you have enough left over, and it could be as low as $900. It's not a very high residual requirement, but they just want to make sure you have enough for your groceries, your cell phone bill. And so that residual income requirement, sometimes on lower credit score, actually gets increased by 25%. So it's just a number that, work with your loan officer and figure out, is this going to be a factor in this loan qualifying? But again, the VA loan is great with lower credit, going down to 500. And again, no credit score, we can do a VA loan. Then we're going to dive into USDA loans. Again, these are zero down, just like the VA loan. You can go lower credit. The USDA loans, you can't go as low of credit as you can with FHA. Typically, their requirement is 600. So it doesn't fit everybody, but it is a good option if you have low credit score. The downside with USDA is that whether you have good credit or not so good credit, the debt to income ratios are very much strict on the USDA loans. When we talk about debt to income, we look at a simple math would be a $5,000. If you make $5,000 a month, 50% is $2,500. So $2,500 would be on VA would be okay to have your housing payment and your total debt ratio would be fine on VA typically at $2,500. FHA, you're going to have to move that down to 47%. $2,300, is that roughly 47%? I did not do this math. The problem with USDA is that's going to have to go down to 31% on the front end ratio, and that's your housing ratio. So the USDA loan really is a small box to fit into, but it is one that we look at with people who qualify. The USDA loan has income qualifying and those ratio as qualifying factors as well. So just things to think about when you're looking at all the different loan programs. Now, conventional loans. So we don't often think that conventional loans are an option with low credit, but I have seen, each scenario is different. So it's very important to look at the big picture with these loan programs. When you're looking at conventional loans and low credit score, it may be the best interest for the borrower. It may be because of the property type, different, the way their income is. They may need a 1-year tax return, and we can't do that necessarily on government loans. So you go conventional, on a lower credit score. Now, typically conventional, you'd want a 640 or above. The higher you go, the better. We can do conventional at 620, but again, we look at all the factors and see if that makes sense for the client. But you can do lower credit score conventional. A few things that happen is often you do have higher interest rates, not super glamorous, but again, the people who get a conventional loan at lower credit, typically it's a short-term solution for a long-term gain. So that higher interest rate isn't really a big deal. And then also having a little more down payment, we can do conventional loans at 3% down for a first-time home buyer. But maybe, again, the way the situation makes sense for them, if they have just a little more down, that conventional loan might work well with that low credit profile. And then also, any of these loan programs, one person with bad credit doesn't look as good as two people with bad credit. Ironically, if you have two incomes, but two bad credit, you likely can do lower down with the bad credit. So something to think about, adding a cosigner on these programs often helps with subpar credit. I went through a few loan programs. Does anybody have any questions before I move on? Nothing. Okay. All right, we're doing good. So quick recap, FHA, VA, USDA loans, and conventional loans, all of them literally have an option for low credit score. Ultimately, your loan officer needs to look at all the different programs you qualify for and really give you a side-by-side comparison. And to kind of flip the script a little bit, even if you have good credit and you're comparing conventional loan and you're thinking that's the way to go, sometimes it's not a bad idea to look at some of these government loans because the overall monthly payment and the down payment requirement may make more sense. We often look at both FHA and conventional side by side. The mortgage insurance rate on FHA is set. Same with USDA, it's set, it's a set percentage. The mortgage insurance on conventional, however, is determined by debt to income and your credit score. So when you're comparing those side by side, it may make more sense to just go FHA. Now, Zach actually went over a really good, a great overview of credit score and how to improve your credit score. That was last week. It's on our YouTube channel. It's great. So I don't even want to go over that, but I'm just going to throw in a few little tidbits to help as you're preparing for a mortgage application, or if you have a client who's going to be going through this and trying to figure out the best few scenarios. So just a quick summary of that. So don't max out your credit cards. Keep them at 30% balance. Nobody should ever do this. Do not max out your credit cards. You need to also pay your bills on time. I was joking, but not joking about the fact that if you literally have a 400 credit score, you're throwing your mail away. So try to just make payment plans, like do something to be active with some of these bills. And then try, when you are looking at your credit, if you have an opportunity, go to freecreditreport.com and you can actually get a list of all your credit items. If there are derogatory items on there, medical debt, old collections, pay them down to zero if you can. Try to get them removed from your credit. And then also, in our office, we make it a practice to do soft pulls, which the soft pulls actually will help you to have a review of your credit report, but not do a hard inquiry, because hard inquiries are also something that can affect your credit. And if you're in a situation where you're buying a vehicle and you're also getting credit cards, like that's just going to bring your credit score down. So things to think about, and talk to a loan officer. I mean, here at our office, again, we do soft pulls so we can help evaluate some of those things for you and see, what you can do to improve your credit. The other thing is just to keep your debt to income ratio in check. When you're dealing with not perfect credit, it's really important that your debt to income ratio is not maxed out. So basically, like I said, the simple math is if you make 5,000 a month, you know, all your expenses together shouldn't be more than 50%. You should, and that includes your credit card, your vehicle payment, your house payment. It really shouldn't be more than 50% of your overall credit. Now, we're not including groceries, the way you spend your money, your utilities, we're not including that, but plan on saving money, paying down your debt, and really trying to keep your debt to income ratio at or below that 50%. That'll really help you go a long way with getting a mortgage. And the one thing that we sometimes talk about is, you know, vehicles. Vehicles and RVs are terrible for a mortgage transaction. And we've all maybe not we've all done it, but a lot of us have done it to where you need a vehicle and then you go buy a brand new vehicle and it's $800 a month. We have seen more times than not that vehicle payment is disabling somebody from getting a house. And it's really sad. So if there's something else you can do, buy a used vehicle that's only $300 a month or something, again, it's some of these things are short term to help you get that long-term gain. And then also saving for a down payment. One of the things that we try to let our clients know is that cash is king. Save for your down payment. For a period of time, you may want to just do minimum payments on your credit cards and some of your other debts that you have, because then what we're going to do within the loan transaction, we're going to look at all the pieces and say, okay, you can actually gain 10,000 in buying power if you pay down this credit card. But we don't necessarily want you to do that while you're saving up money, because sometimes maybe, on a VA loan, the seller can actually pay down that credit card. So there's ways that, we can talk about how to maximize your cash flow, your down payment funds to help with your overall mortgage experience. Because then again, like I said earlier, sometimes just a little more down payment, and even VA, we did a loan a couple of years ago where he just had $2,000. $2,000 is all he needed for a down payment to get him into approval. And we were able to maximize debt ratios. It was VA loan, and it was one of those things where he wanted to do zero down, but it was a game changer by him just contributing $2,000. And then, when we're also talking about down payment and having your own funds, sometimes getting a gift from a family member also helps. The caution, though, is when you have a low credit profile and you're trying to make all these pieces work, the down payment coming from a family member doesn't look as good as your own funds. So a way to avoid that, we know grandma's going to give you $10,000 for your house purchase. She knows that she's going to do that. Why don't she just gift you the funds now? And then in 6 months, you buy your house. Well, those funds have been sitting in your bank account for 6 months. They are your funds. You can now use those funds as your funds. And we technically only need 2 months, but it's just something, if that conversation is already happening, then make those funds your own by having them seasoned in your account. Then that looks a lot better for when you go to do your mortgage, because those funds are yours and you're not perfect credit will be compensated by that 10 grand coming from your own pocket. And then again, interest rates are affected by the credit score. So the more you can kind of be ahead of this process and have a loan officer, have one of us look at your credit profile and see what we can do, because going from a 580, or even if you have a 575, getting to 580 could be a big difference in your terms. And then that next jump, 600, 620. So all those little milestones really will help your success as a homeowner. And then, finally, I talked a little bit about mortgage insurance. So that's, again, comparing mortgage insurance on conventional and government loans and how they're affected by credit and DTI. So just something to keep in mind. But then finally, just budget for home ownership. You're looking at your future and you're trying to figure out, like, how am I going to buy my own home when I'm renting right now? Go through and, go through a whole budget. I used to do budgeting and then I stopped for a long time. And then just this last year, I myself got back into it and I just wrote down everything we spent. And it's amazing when you write down everything, you realize, wow, I spend a lot of money on crap. So just even taking an extra $200 or $100 that you may spend on going to the coffee shop, or, bring your lunch to work instead of going out and having lunch, like those little things, like pay that $200 medical collection that you have, that literally will create a better future for you than you going out to lunch every day with your friends. So and again, everything that we talk about is about building equity, gaining home ownership for financial freedom. And again, I go back to some of my first transactions were literally clients, 580 credit score, sub 580 credit score. And now I see them, they have 300,000 in equity in a house that they bought in 2017. So you have to start somewhere. And it was hard for them when they started. And I see them now, they have no debt. They have a house that has 300,000 in equity. And they literally started with, not the best terms, having to put a few dollars in, but it's been a life changer for them. So yes, question from the audience.
What happens to the credit score once you get the mortgage?
Yeah, actually, that is on my list. So and that's like the example that I said about, the clients that I worked with earlier in my career. 6 months of payments with a mortgage drastically changes your credit score by hundreds of points. 6 months, just make 6 good payments. And then a year, I mean, the more you make, the better, but literally 6 months, it's a game changer for people. Oh, the question. Okay. Yes. Sorry. I forget about that. Zach's question was, what happens with your credit score once you get a mortgage? And yeah, it's super simple, like making 6 months. Someone with 580 credit score making 6 payments can jump up to potentially 800. So does anybody else have any questions? I am 5 minutes early. Yes. Great. Next week, we're going to do some more credit. I can't think of the topic offhand, but anyways, our list is on our website. It's Fix Your Credit February. So it's all about credit. Yes, Dave.
What's the good excuse for if you had bad credit past and you're going to get a loan and you have to explain your prior bad behavior?
Oh, gosh. It was a one-time occurrence and it's unlikely to happen again.
And you fixed it. Yeah.
And I fixed it. It was a one-time occurrence. I fixed it and it's unlikely to happen in the future.
It was outside of your control.
It was outside of my control. Yes. I don't understand. I've been in this industry for 9 years now, and I still have to ask Dave for help on explaining stuff like that. Like it is like ingrained in his brain, but anyways, still working on it. So, any other questions? Thank you all for coming. This was a bigger class. So I appreciate you guys, and join us next week at 10. And you guys have a wonderful week. If you're in the Flathead, it is sunny and beautiful. So thank you.